Hello everyone, Stephen Furness here, Director MGD Wealth, and in today's capacity, Chair of our Investment Committee efforts here at MGD. Today is early August, around 7th of August, and I'm pleased to be joined by a familiar face, Sean Hollins from WTW, Willis Towers Watson, and a new face to these investor updates, Aliya Abbasi, who works with WTW and in the sort of macro team, forecasting, economics team. So nice to meet you, Aliya. Sean, there's a fair bit going on. This is a short, sharp update for our investors, just to reflect on the last few weeks. Seems to be a lot going on in the world. We do have investment committee season coming up soon, so in our normal course, we'll send an update on that separately. But what's happening? We're jumping around a lot, Sean.
Yeah, we are. There's a bit happening in markets over the past few days, both from an economic standpoint, but also how that's translated into market movements in a vast array of different markets, whether it be equities and bonds, Japan, US, Australia. But I might let Aliya discuss exactly what's been happening.
Thanks, Sean. So it's definitely been a volatile start to the month. So over the first week of the month, we saw a number of economic developments, but what really has driven a lot of the market volatility we've seen over the past week is relatively weak economic data coming out of the US, and that specifically relates to the labour market and also the manufacturing PMI. So what this did is it really catalyzed a lot of volatility in the markets that we've seen. Some of these moves have now reversed, but really what's happened is that when you look at US data so far into the year, everything was quite positive. This all really signaled moderate growth. But these recent data points have led market participants to really question the soft landing scenario that's been priced in. And the data surprises sort of initially led markets to think, well, has the Federal Reserve potentially over-tightened rates in America? And so as a result, we saw a lot of significant moves in equities, bonds, and credit markets, as you mentioned, Sean, particularly in US Treasury yields. So we saw drops in yields across the short and long end of the yield curve. This really reflects shifting expectations around the timing of easier policy from the Fed. And the market has really priced in a larger number of cuts over the next 2 years. We also saw a sort of off sentiment sweep through equity markets. There were other contributors to that as well, such as slightly weaker earnings reports from some of the Mag 7. So that really brought into question the whole AI rally and positive theme that markets have been sort of following throughout this year. Within equity markets, we saw quite a significant drop in Japanese equities in particular. So the falls there were in the order of 20%. While a lot of this was driven by recessionary risks and concerns around those risks in the US, it was also driven by a significant unwinding of the popular carry trade. And so really what happened was the yen appreciated significantly, and that led to some forced selling on the Japanese market. So that really brought into question some of the Japanese rally that we've seen over the year to date as well.
And we were chatting internally around the yen Australia exchange rate when it was 107, and I was planning my Japanese holiday, but it changed overnight very quickly. It's amazing how quickly things can be reflected in markets, I guess.
Yeah, that's correct. So all it really took was a surprise decision from the Bank of Japan, and then away we sort of saw the reversal of that popular trade through the year.
Yeah, with Sean, the Magnificent Seven, those high-profile stocks, the earnings uncertainty, how much commercialization success might come out of AI, etc. When things are potentially richly valued, it doesn't take much of uncertainty on earnings to really see some of that repricing in securities that have had obviously such a significant run over the last year or so.
Yeah, that's right. I mean, there's been a big pile into the Magnificent Seven, and as you say, it doesn't take much for, I guess, that whole thesis to come into question. Now, I don't think we're saying that AI is dead at all. It's just that there's been a lot of enthusiasm around AI, a lot of sort of blue sky sort of priced into future earnings. So anything that sort of doesn't quite meet that, it's pretty easy for investors to reverse course.
Yeah. So Aliya, the US interest rate cycle, what's sort of the house view on actual number of cuts or magnitude of cuts that you're expecting over the next 6 to 12 months?
Yeah, so I think this year, we think that what the market is pricing, so between sort of 2 and 3 cuts, we don't think that's unreasonable, particularly given what we've sort of seen in the US is this really unique situation where you have inflation coming down without a significant sort of uptick in unemployment or deterioration in the data. So that really suggests that the Fed can sort of take their time this year. I think the market's probably got it quite right in terms of what's being priced in now. And that's really what's led us to sort of shift our view on US yields and interest rate duration.
Yeah. And domestically, we had a Reserve Bank meeting yesterday, certainly sending the message of no cuts here anytime soon, and to expect status quo on interest rates, at least for the time being. Is that, you agree with that view?
Yeah, definitely. So I guess the challenge with Australia is that services inflation here has been quite sticky. So we did see a slight softening in core inflation in the most recent print with regards to the second quarter of this year, but it's really not cooling to the extent that the RBA would have comfort to cut rates anytime soon. So we think that the most likely scenario is that they will cut sometime next year. And as a result, that's why we're seeing Australian bond yields sitting at a higher level compared to the US.
Yeah, very good. Sean, I know just from a broader portfolio strategy, the more stable strategies that we are privileged to help manage, a lot of that bond exposure, duration exposure that we have had has worked nicely recently. Just from a general point of view, longer term growth portfolios, same sort of message, I imagine, in the way we see the world of really looking at your sources of return and making sure you're really well diversified.
That's right. Yeah, I think it's sort of a message to stay the course. Yes, there have been some pretty violent market movements over the past few days. And we have actually taken the opportunity to reduce some of the bond exposure, both within the more conservative, but also the growth portfolios, and taken profits there. But just more generally, you know, we don't react too much to short-term noise. And yeah, we do build diversified portfolios, and we expect that strategy to sort of pay dividends over the medium term.
Very good. Well, I thank you both for your time today. Very nice to meet you, Aliya, and we'll chat soon. Thanks, guys.
Excellent. Thanks, Stephen.
Cheers.
Thank you.
Bye-bye.